Welcome to the 2017 second quarter investment call with the San Diego Foundation. Thank you for joining us today. The Foundation implemented quarterly investment calls as an enhanced service to donors. The calls provide direct access to our investment leaders in a consistent, convenient, concise format so donors can remain informed about the performance of their charitable assets. Leading today's discussion will be Horacio Valeiras and Matt Fettig. Horacio Valeiras is the president and principal of HAV Capital, LLC, and is a member of the San Diego Foundation Board of Governors. He also serves on the Board Investment Committee. Horacio has more than 26 years of investment management experience. As Chief Investment Officer for the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to foundation investments. Today, Horacio and Matt will start the call with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio and our long-term, medium-term, and short-term portfolios. We will conclude with a 10-minute question and answer session. To submit questions for the Q&A session, please use the questions chat function anytime throughout the call. Any questions unanswered during the call today will be answered via email. Tomorrow, attendees can access slides and a recording of today's call on our website, sdfoundation.org. Now, Horacio Valeiras will get us started.
Hello, everybody. Good afternoon, and thank you for joining us. We're going to, as Adrian said, we're going to follow the same format, but today we're going to start with a look back at what the equity environment, everybody's heard how well equities have done over the past year, and in this first slide we show the returns of various different types of equities for the last quarter, which would be the second quarter of the year to date through the second quarter, and then the 1 year, past 1 year, so basically from the end of June, beginning of July of 2016 through the end of June 2017. Split up into various categories: U.S. large cap, U.S. small capitalization stocks, U.S. large cap value and growth stocks, and this is really a split that's done on valuation of the company. So value stocks would be those with lower valuation, growth stocks would be those with higher valuation. International large cap, as represented by the Morgan Stanley Capital International MSCI EFA index. The Eurozone, which would be the countries that are part of the Euro currency bloc, the United Kingdom, Japan, and then emerging markets. And what I'd like to start is have you focus on the far right column, the 1 year total return. You'll see that everything has given pretty good returns. Most of them are in the teens or in the 20% for the last year, which is actually a very good year for equities. Most of this rise occurred after the election in November. But as you can see, U.S. large capitalization stocks are up 18%, but heavily biased towards large cap growth stocks, in particular stocks like Facebook, Amazon, Netflix, Google, Apple, a lot of the technology companies. While the value stocks, those that have lower valuations, have only returned about 5%. Now, smaller capitalization stocks, the smaller companies, have done better than the large companies. But if you look at the middle column, you'll see that that's really only happened, that only happened last year, because this year the small capitalization stocks have actually done worse than the large capitalization stocks. The one thing we have benefited from, if you participated in these calls in the past, you'll know that we have a bias in our portfolio to a well-diversified global equity portfolio. And you can see that for the past year, European stocks, Japanese stocks, and emerging market stocks have all beaten the U.S. large cap stocks, which means that by having a global bias and by having an overweight to those regions, since they're, from a valuation perspective, they're actually cheaper than U.S. stocks, we have actually, your portfolios, the funds, the assets under management at the foundation have actually done better. And Matt will explain the performance attribution and the performance of the overall portfolios in a little bit. The other thing I'd like to point out is that while a lot of the return has come since the election, it's really been two different periods. The original, what we'll call the Trump trade, which was to buy financials and small capitalization stocks that were going to benefit from tax reform and less regulation, which did very well in the last quarter of last year, have actually not done as well during 2017, during calendar 2017, as a lot of those policies have gotten dragged out and have not been implemented. If we can turn to the next slide, you'll see that one of the things that has us a little bit concerned about the equity markets is actually shown in this chart. This chart shows the implied volatility of U.S. equity markets. Volatility is really a measure of how much stocks vary over time. And as you can see from this chart, the lower this line is, the lower the volatility, the less the variability in returns, the less the variability in returns of stocks. You can see that we're pretty much at an all-time low in volatility. Now, generally, when this happens, it's because people are very complacent about the environment that we're in. You can see it in equities, and that every month they seem to go up, and no matter what is thrown in front of them, no matter what concerns come up about politics, about interest rates, or about geopolitical forces around the world. And this, if you look at other periods where volatility has reached this low level, you can see that a few months later it was significantly higher. A spike in volatility is usually accompanied by a correction in equity prices. So just as a warning, while we've had a pretty good years for the last couple of years, and really for the last 9 years, this low volatility is really indicative of too much complacency in the market, which we're keeping an eye on. If we can turn to the next page, next slide. There we go. You can see what's going on the bond side of the portfolio, the interest rate environment around the world. And what we have here is by country. We have short-term interest rates, 3-month rates. All these are on Treasury securities, so they're on government-issued securities, and then the 10-year rate. You can see the United States, where we've had 4 rate increases. The short-term interest rate is at 1%. The 10-year bond is at 2.3%. Right after the election in November, the 10-year bond spiked all the way up to 2.6% yield, but since then it has rallied, and actually the bond markets this year in the U.S. have returned almost 4%, which I think if you asked most investors last year what was going to be what was going to be going down this year, they would have said bonds. That hasn't been the case. So the bond market continues to reflect this benign environment as well. It's not just the equity market with volatility. The other thing to keep in mind is that the European short-term rates are still negative. If you look at Germany, France, Spain, and Italy in particular, and then Japanese short-term rates are also negative. They are still carrying out expansion of their monetary policies, expansion of central bank balance sheets. However, rumors of stopping those expansions in Europe have actually caused the euro to strengthen quite significantly against the dollar this year, and has caused 10-year rates, which the last time we talked were lower than what you see on this page, to go up a bit in the European markets. You can also see that some of the emerging markets have significantly higher rates. We do continue to like emerging markets, both on the equity and the bond side, because of these higher yields, and that's something that's reflected in your portfolios. We actually expect the U.S. to continue to raise interest rates slowly. We're not expecting much of a move out of Europe in the short run. And we shouldn't, in our view, we shouldn't see too much movement of the 10-year rates over the next 6 to 12 months. But we'll keep an eye on it for you. With that, I'll turn over to Matt, who'll talk about the portfolio. Oh, sorry, one other chart. Federal Reserve balance sheets. I mentioned a little bit on the last chart about where the central banks were. This is the Federal Reserve, and you can see that the top of this line, the blue is mortgage-backed securities, so basically packages of mortgages on property. Treasuries are Treasury securities that the Federal Reserve has bought, and then other would be agencies like Fannie Mae, Freddie Mac, those kinds of things that the Federal Reserve has bought. The Federal Reserve in 2008 started a program of expanding its balance sheet, what they called quantitative easing. You can see that really since about mid-2015, they haven't increased the size of the balance sheet. They've been holding it steady, and they have started talking about reducing this balance sheet. And the method by which they reduce the balance sheet may have implications for the market, but so far very few details have been announced, except that they're going to start sometime in the near future. It's in combination with the higher rates, but it's another thing that we'll keep in mind. Europeans are still expanding their balance sheet. The Japanese are still expanding their balance sheet as well. The U.S. is the first one that's going in the other direction. So with that, I'll turn it to Matt.
Thank you, Horacio, and thanks for the comments. I'm going to get into some more specific information on the portfolios that we manage on all of your behalves with your charitable dollars. And I'm going to start with just some broad comments that really further follow those made by Horacio. We just ended out the fiscal year of 17. We are on a June-end fiscal year. So I'll also tailor some of my comments more towards the one-year period rather than just the most recent quarter. But certainly that first exhibit that Horacio showed, where you saw double-digit rates of return for various equity markets, has been the biggest driver of the absolute results of the portfolio. So you can see here for the endowment, we were up 2.6% for the quarter, but over that one-year period, a double-digit 13% rate of return. So there were several drivers, but I would say our positioning, where we've had more in the non-U.S. equity markets, that includes emerging markets, than perhaps some of our other peers, has certainly been a big benefit. Remember, that was a detractor a few years back, but we have reaped the benefits of that as of late. If you look on the quarter, the most recent quarter, that trend continued. Emerging markets outperformed certainly the U.S. markets, and other non-U.S. markets outperformed as well. So we are continuing to benefit from that trend. If you look at how we did relative to the policy index, which again is really the benchmark that we've created to measure this portfolio against, you'll see on a one-year basis we also outperformed the policy index by a fair margin. And that really came out of our fixed income portfolio. So despite the fact that fixed income interest rates are low, yields are low, we have looked at certain credit-oriented spread sector-oriented areas to add some additional yield to our portfolios. You saw the yields on a couple slides ago that you're getting out of markets like Brazil and Russia. We do like some of the emerging market bonds out there. We've also benefited from a move in areas like high-yield bonds. And as a result, over the last year, our fixed income portfolio has been up 6.5%, with the corresponding index up only half of that. So a lot of the relative performance to our benchmark has come out of that fixed income area. Other areas of interest, our private equity portfolio has done quite well. Oftentimes private equity tends to follow public equities in a sense based on the way these companies are valued. Our private equity portfolio was up close to 16% over the last year. I'd say the one area that detracted continues to be commodities. And while we had this commodity super cycle come to an end a few years ago and really a bear market in commodities, recall there was some snapback and there's now been softness again in that space across the board. So of all the assets that we invest for you within the endowment fund, the only area that produced a negative return for the 1 year period was that commodities area. Just a quick note on the quarter. We had a decent quarter. I wouldn't say it was a great quarter. We benefited from some of the trends that I mentioned. But we have active managers that build portfolios on our behalf, and we have them designed to outperform their respective index over time. And unfortunately, some of our managers have a value orientation, meaning they buy cheaper stocks. And as you saw in Horacio's first exhibit, cheaper stocks have not done as well. And so the value orientation that we have in our portfolio, where we like to buy assets that are cheaper than expensive, has hurt us a little bit on a short-term basis. I'll end on the endowment. We're very proud of the fact that we've reached a point here where if you look at the 1 year, the 3 year, 5 year, 7 year, and 10 year, we're now either at or outperforming our policy index. And if you rank us, we like to rank ourselves and our portfolio's performance against a set of peers, other nonprofits of similar size. We rank above median for all those time periods I just mentioned for the first time in some time. So we have certainly benefited from strong results and are happy to share those results with you. If we flip to the next page, we'll get into the non-endowment portion of the portfolio. And again, many of the same themes hold. International equities, including emerging markets, was the bright spot of the portfolio. It produced high absolute returns. Our fixed income portfolio produced strong relative results to the benchmark. And you can see over the quarter, slightly behind, but over the 1 year number, we were well ahead of the policy index and feel we had quite a good year here. Commodities, again, were the one detractor, but all other areas of the portfolio produced strong positive results. Next page shows the medium-term pool. Again, this is a more conservative pool. Only 30% of the pool is invested in equities. The rest of it invested in primarily fixed income or bonds. You can see same thing here. We had 15% in non-U.S. equities, which helped us. And again, you can see our 1 year number. We outperformed our policy index by over 1.4%, which is a very large margin for 1 year. And a lot of that had to do with those spread sector bond or fixed income managers that we have utilized in this portfolio. And then finally, on the next page, you will see our short-term portfolio. A reminder, the short-term portfolio is invested entirely in money market funds. The good news is, as we've continued to see interest rate hikes out of the Federal Reserve, we have slowly seen the yield in this portfolio increase So at least your cash sitting here is now starting to earn some income, whereas it hadn't for a number of years due to the historically low interest rates. So with that, we want to open it up to questions. I would urge you to use the question and answer panel on your screen and submit any questions that you might have. We will start with a question, and I'll ask Horacio to answer this question. What impact, what impact may the damage from recent hurricanes Harvey and Irma have on our portfolios in the short and long term?
Thanks, Matt. So that's a fairly complex question in the sense that there are any event like Harvey and Irma, any events can have very different impacts depending on time frame and depending on what you hold in your portfolio. But let's start with the economic impact. The general economic impact is twofold. One is you have a depression. Before the storms, you usually have an increase in economic activity as people get ready for them. Then as the storm comes through, you have a decrease, and in the aftermath, you have a decrease in economic activity as people are looking to get their lives back in order. And then in the longer run, there's an increase in activity due to replacement of assets that were destroyed. Having said that, the cost to replace those assets then resides mostly with insurance companies, and you do see you see an impact on in places like Home Depot and Lowe's and places like that, more spending. You also see a reduction in other areas, restaurants and a few other sectors. So overall, it's very hard to tell exactly what the impact is going to be, but by and large, there's usually after a few months there's a significant positive impact to things like construction activity and retail for home builders. Now, having said all that, our portfolios that we manage are pretty diversified. So if you look at our real estate managers, they own assets all over the country, and while they may own assets in the affected areas, those assets are insured, and they also have a minimal impact on their overall portfolio because we don't use anybody that has heavy regional exposure in one place or another. On our equity portfolios, once again, our U.S. equity portfolio is largely indexed to the market, so we get exposure to all the sectors. So we'll have some that will do well, and we'll have some that won't, that will be affected by the hurricanes. But overall, once again, the impact on the return should be muted as they are well diversified portfolios.
Thanks. Next question we have, as we get later in the economic cycle, what changes have you made to the portfolios you manage on our behalf? And I'm happy to take a swing at this one. I'd say over the last several years, and we're talking last, let's say, 2 years now, we have been aware that we are getting later in the economic cycle. Now, nobody knows exactly where we are in the economic cycle. It's fair to say later, but it's also fair to say that, this market, while fairly valued to overvalued, could continue to get richer, and it could continue for some time. So we're certainly not trying to time the next recession, but we have been taking chips off the table fairly slowly. So I think if you look at our exposure to the equity markets, on the margin, they have been reduced over the course of the last couple of years by as many as 5 to 10 points, depending on the particular portfolio. And I think you will likely see us in future months look at some of the bond portfolio where we've had some spread sector exposure and make sure that we don't have too much there. And kind of continue to lighten up at the margin. So that is our plan. It is an ongoing plan. We, again, are not market timers, but we are aware that we're in, I believe it's still the second longest economic expansionary period in history. We have another question here. How does your policy index compare to other benchmark indices, the market, etc.? And I'm happy to answer that one too. And I think we touched a little bit upon this on the last call, and I think this is an important point to emphasize. And that is our policy index is really an index of indexes or indices. So essentially what we're doing is if our portfolio, if the endowment portfolio, and if we could go back to the endowment slide, I'll use this as an example. But if our endowment portfolio has 24% domestic equity, we're likely to select an index that, like the S&P 500, that is representative of the U.S. domestic equity market. And we'll weight that 24%. If we have 10% in domestic fixed income, we're going to choose an index weighted 10% that represents that domestic fixed income market, and et cetera. So essentially what we're doing is we're trying to find an index that represents each segment of our portfolio, and we're weighting them accordingly based on the strategic long-term asset allocation that we have selected. So we feel this is the best fit index for our portfolio. Our portfolio is not 100% stocks or equities. Therefore, we don't think it's appropriate to measure against the S&P 500 or an all-stock index. That said, we are aware of what each individual segment of the market is doing. And we, again, feel that this is going to be the best fit for this particular portfolio. I think with that, no more questions. I'll turn it back over to Adrienne.
Thank you again for joining us today and for partnering with the San Diego Foundation to maximize the impact of your social investment. Today's presentation will be available by the end of the day tomorrow on our website, sdfoundation.org/investments. Have a great day.